Tesla stock took an absolute dump. Welcome to the Fiscal Philosophy YouTube channel. I'm here to give you the value investor's take on Tesla stock. I personally do not currently hold Tesla, although I do have a target price in mind that I came up with in the past, and I may take a look again here and see if maybe I would revise it at all after this latest drop in share price after a pretty disappointing earnings. Basically, Tesla missed both on the top and bottom line, from my understanding, and showed kind of a slowdown in their revenue growth. Now, deliveries of actual number of cars seem to be, doing quite well. They're delivering a lot more cars today than they were a few years ago. But with all the price drops, etc., they just aren't getting as much money out of it as they used to. So it's a trade-off, like in all things. So just to start off, I do want to give all the credit in the world to Tesla for the massive amount of revenue growth that they've had over the last 10 years. Very few companies ever achieve revenue growth rates this tremendous. Now, there have also been times in the past that have looked an awful lot like revenue growth plateaus. And I would say at the current moment, it does, in the moment, appear like we may be in a revenue growth plateau where maybe the growth might be slowing down from here going forward. I can't say that for sure. And again, in the past, it has appeared that way and then ended up accelerating again. But I generally speaking would not bet in most cases for a plateau and then another future explosion. At some point, the music stops and the plateau that you hit is the real one, and growth just stays a little bit slower than it has been. So that's something that I think every investor ought to at least keep in mind. One thing that I would personally be actually excited about if I was a Tesla shareholder, even if the growth was starting to slow down some, in the event that they can scale back on some of their capex in the future and, operating cash flow and revenue stay basically the same, a lot of this money that's currently going out the door to capex would just become straight up free cash flow in the business. And that could be used then in the future to greatly reward shareholders. And also remember, even if that did come to pass, without some future growth being assumed, they would still be quite expensive because their operating cash flow, which is basically the number before you take out the capex, still leaves them trading at a high 40s multiple. And, it tends to fluctuate some. At their lowest point, they were in the mid 20s on this multiple, and they've been over 100 as well in the recent past. So at all of these points in time, I think a lot of growth was being assumed and is still being assumed to this day. I think it is important to kind of be careful of that and not overpay for the cash flow that the business will be able to provide, because ultimately it's the cash flow that they have to use to reward shareholders. That's sort of my criticism with the Meat Kevins of the world, who are happy to assume the high growth in perpetuity and also assume super high multiples in perpetuity. And I just think for decades, that doesn't really usually pan out. Also, what can we glean from these price forecasts? Is any of these price forecasts correct? Maybe, maybe not. But what it tells me is that even the so-called experts, the Wall Street analysts, are extraordinarily divided as to what is reasonable to assume for the future of Tesla. So on the low side, you have somebody thinking, hey, probably slower growth from here, if growth at all, $85. And on the high side, you have tons of growth in perpetuity. This is a tech company, not a car company. AI. It's the future, bro. Probably. At least that's how I imagine it. And even when I look at, the average consensus on revenue and EPS growth over the next few years, it seems to be a little bit over optimistic in some cases. Now, maybe it's somewhat achievable if, again, spending and capex are greatly reduced, but beyond the next handful of years, what is like a reasonable, sustainable growth rate? I like to run multiple scenarios when looking at a stock, and in this one, I'm running an assumption on Tesla that 2025's analyst average consensus earnings happens. They get $5.10 EPS, giving them credit for their balance sheet, assuming, again, after 2025's pretty optimistic numbers get achieved, that they do 10% growth per year for the following decade, followed by 7% after that. These are not slouch growth numbers for a company the size of Tesla. And even still, we come out with $111.56 that it will be worth in 2025. Now, you can justify pretty much any price you want by putting in the assumptions that you want to be true. However, I'm trying to think about what's reasonable. Now, scenario number 2 is the one that I'm a little bit more biased towards as a value investor. In this scenario, I credit them for this year's EPS estimates of $3.92. Now, it could be that the consensus and the forecast and the guidance has changed or will change in the near future, but this is what's in the data feed right now, so I'm rolling with this. I'm applying the 12% discount rate because if I'm going to, take a chance on Tesla achieving growth numbers like 12% a year on EPS over the next decade, I want to try to get an outsized return. And basically, if they miss on that sum, I'd like to still end up with like a 9 or 10% return, even if I'm off by a bit on my estimate there. So that's why I use that higher discount rate. And on that, I come out with a fair value of about $86 to $87, which, again, I told you 9-10 months ago when I ran some numbers, I came out with 90. So we're in that ballpark. This is also pretty similar to that low-end analyst price forecast. So I think I see where that analyst is coming from. And just remember, these numbers are not facts yet. They're simply assumptions about what we think Tesla will do and, the return we want to achieve if they hit those assumptions. The possibility still exists that they could blow this out of the water, in which case they may still be overpriced, to be honest with you, even if they do a bit better than this. But they could also do worse. And by using a higher discount rate, I prepare for that. At the end of the day, with an assumption like this, if they hit my buy price and do a bit worse, I don't get burned so bad. But if they do, for example, a lot better and I buy them at my buy price here, well, I'm going to be doing really well on the position. And at the end of the day, that's what investing is all about, setting up your future self for the greatest chance of success. So that's really why I go a bit more based off of these type of assumptions. There's a difference between pricing something to perfection and pricing something for perfection. Pricing it to perfection means that you hit the nail on the head and you guess everything almost perfectly. Pricing something for perfection means to justify the price you're paying, the business has to perfectly achieve everything that you assume. Otherwise, you end up getting, we'll just say, substandard returns. Thank you for making it to the end. Reply down below with your hot take on Tesla stock. Give the video a thumbs up if you liked it. Subscribe to the channel for more. Follow me on Twitter X at Mr. Macho Mog. Go on the Discord, link in the description. Consider becoming a channel member and join me 8 p.m. every Saturday. Cashflow Kings Live, link in the description. Take it easy, everyone.